Well, after a wild 2013, the capital markets have been relatively calm during the first 5 months of 2014. Stocks and bonds have edged up in value, but have a much more gradual rate of ascent than last year. This lack of volatility is reflected in several investor measures that capture the level of aggressiveness in the markets. There's a specific measure called the VIX that captures concern or fear in the marketplace, and this measure may help us see what is likely to happen next. In this morning's U.S. Bank Economic 360, U.S. Bank Wealth Management Senior Equity Strategist Jim Russell joins Business Courier publisher Jamie Smith with more on how the VIX works. Jim and Jamie.
Thanks, Peg. Jim, thanks for being here today.
Good morning, sir.
Now, I'm assuming this isn't the VIX. It's going to help my cough go away, right?
It will not, no.
Tell me what it is and what it really means.
Yeah, the measure of the VIX really measures the volatility, and technically it's a mathematical formulation that measures the implied volatility of the index options in the S&P. So what does that mean for you and I? It really has a little bit of predictive value, Jamie, where it kind of does show maybe market participants at least what might happen around the corner, what might happen next. It's often called the fear gauge in the marketplace, and high readings means there's high fear, low readings means there's low fear. It does move in opposite directions of the S&P 500, and as you know, the S&P 500 hit a couple of records recently, as recent as last week rather, and so the VIX is really showing a fairly low reading right now. Okay. It spikes when the market goes down quite a bit, and right now it's really trading at 7-year lows. So we're thinking it's signaling a certain something out there.
Were there times, periods in our history where the VIX suggested that were good times to buy, good times to sell?
Yeah, you always want to buy low and sell high. So, you know, in terms of market sentiment, believe it or not, you frankly want everybody to hate the stock market. That's a good time to buy it. When everybody's in love with it, maybe indicates it's a little bit toppy, a little bit on the high side of historical ranges. And so what we have here is a graph that shows where the market VIX reading has spiked. This, the three readings that you see there are really associated with the financial crisis. Okay. And, you know, all of the fear, all the uncertainty, the investor angst that surrounded that, the flash crash, etc. But you can see over to the right-hand side that the VIX has really kind of calmed down. It's really kind of tracking at a lower level, and that's where we are currently, again, at about a 7-year low. That does indicate that investors are somewhat complacent and maybe even a little bit confident. Okay. So that's maybe not what we want to see.
Well, how does one find this out? I mean, like, you know, the common guy, how do I go find this out?
Right. It's on several different websites. One that I use and that we use at U.S. Bank Wealth Management, Bloomberg.com, but several business type, market type websites would have a daily reading of the VIX, and it does fluctuate during the course of the day.
Well, it sounds like there's some pretty accurate readings.
Yeah, there's some pretty accurate readings there, and there are, you know, there is some, again, some predictive value in looking at the VIX. Right now, again, it's flashing a little bit of complacency. It's not the only sentiment indicator that we look at. Other sentiment indicators that we look at does indicate that investors are a little bit worried about the market, and so that's what you want to see. But it is indicating a certain lack of fear in the market. Again, a complacency that you don't want to see, which maybe takes investors to maybe emphasize the risk aspect a little bit more than they should. So with the markets at all-time highs, we still think the markets can be invested in. We think it's probably fairly valued, and that bargains are much harder to come by. So just another arrow in the quiver, something to look at.
That's great.
And something that is tracked by the professional investor.
All right. Well, thanks for informing me of this new word, and I'll be sure to look out for it.
Thank you, Jamie.
Jim, thanks for being here today. We'll see you next week.